Welcome to the 401k Audit CPA Success Show, where we're 100% focused on helping companies across the United States prepare for their 401k audit. If you have 100 eligible participants in your 401k plan, then this podcast is for you.
Hello, everyone, and welcome to today's episode. Today, we are going to hit on a topic that we actually talked about, I think maybe a year ago or maybe a couple of years ago. We're going to talk a little bit more about the Secure Act. So I know there was an original passing of this in 2019, and they're actually thinking about passing a Secure Act 2.0. So we're going to go into the details of what's in that current legislation. Obviously, it hasn't passed yet, but it's definitely worth talking about so we can kind of get you ahead of that. So welcome to the show, Kim.
Thanks, Jamie. Glad to be here. Thanks, everybody, for tuning in. This is a topic that it's getting some attention from folks. And we're going to talk about why here in a little bit, but it is something that you need to be aware of. As Jamie mentioned, it's not passed yet, so obviously subject to change, but very important. If it does pass, it'll probably become effective pretty quickly. So we wanted to kind of get ahead of it and let everybody know that this is potentially coming. We thought we'd start off talking about the actual legislation that did pass, the Secure Act 1.0, or it's actually called the Secure Act. Passed in 2019. That it stands for setting every community up for retirement enhancement. Of course, Congress has to come up with some big long name, that gets abbreviated. And so we'll never talk about that again. It'll always just be the Secure Act. Now, the Secure Act, when it was passed in 2019, most of it came into effect either at the very end of 19. We're going to talk a little bit about this as we kind of go through each section of it really quickly. Some of it in 2020. So it's kind of all over the place. There's not like one rule. So that we'd go through the components of this because the Secure Act 2.0 follows along with this act that's actually been passed, and you'll see as we get into the 2.0 why it's important to understand the first part of it. The first part of it that got a lot of attention is that it allows multiple plans to pool together to join a pooled account. So the thinking there from Congress was that small employers that they want to offer a 401k plan, but the administrative costs are too expensive. If they could pool together, they could share the expenses. And get a better plan for their employees without the added cost. That would be effective after 12/31/20, so it's in play now. That got a lot of attention because obviously that would allow more players in this space. Second thing is it changed the automatic enrollment cap from 10 to 15% of pay. That became effective beginning in 2020. So if you, in your plan, say if you participate, we're going to raise your deferral percentage. So you're going to go from a 5% deferral to 6% to 7% to 8%. A percentage usually is what they do each year. Was capped at 10. This is going to change it to 15%. There was some safe harbor changes. I'm not going to go into those because they only apply if you're safe harbor. Then there were some tax credits that happened as part of this. Again, incentives to small businesses to set up 401k plans for their employers. So there was increasing credits to small plans to start a 401k plan, and then a new tax credit up to $500 if you started a plan and added the auto enrollment. So auto enrollment means more people will be enrolled in the plan because you're automatically putting in the plan unless a person, they have to physically decline it versus actually physically enrolling in it. Now, the big thing, though, that I think most people need to really pay attention, unless you're a small plan or a small company and you don't have a 401k plan, then that first item we talked about is probably more important. But if you're a business that has either part-time employees, that's the big one, but it also impacts if you have seasonal employees, or if you have employees that maybe kind of come and go a lot, so they're with you for a while, then either they leave on their own, or maybe you have some fluctuations in employment needs, so you let them go and then the business picks back up again and they come back. So if you have people coming and going for any of those reasons, the rules have been that unless they work 1,000 hours per year in general, you didn't need to offer the plan to them. So we have a lot of people that say, well, my plan rules are blah, 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 whatever they are, except for part-time people. Of course, they're not eligible. This changes that. You now have to have a two-part eligibility requirement. So one requirement for full-time staff, which you can set. There's a lot of variations there, but you also have to have this second option for these part-time, seasonal, et cetera employees. If they work more than 500 hours of service in a year for 3 consecutive years, then you have to offer the plan to them. The reason that I make such a big deal about this is because it will go in effect beginning now, 2021. So it started for years after 12/31/20. Not in the sense that you have to start offering them enrollment, but you have to start tracking. So in 3 years, potentially, if you had employees that hit that 500-hour mark, then you're going to have to offer the plan to them. And you're going to have to track, because if somebody comes to you and says, hey, I'm eligible for the plan, why didn't you offer it to me? You're going to have to be able to prove that you shouldn't have, that they didn't hit that mark, or vice versa, that you have to be able to prove you did offer it if they hit the mark. So, we're not sure payroll companies are set up to handle this. It may be a manual tracking on your part. Might be a bunch of spreadsheets, or, I don't know. I don't know how people are going to do it, but you're going to have to start tracking, and you don't want to go when this actually hits the 3-year point, then all of a sudden you got to go back and try to figure it out. That'd be a nightmare, especially if you got people coming and going a lot. So we really wanted people to be aware of that. So keep that in the back of your mind. 3 years consecutive, 500 hours.
And just a reminder, so we did do this podcast. I went back and looked while you were speaking, and we did it in February 17th of 2020. So it was a little more than a year ago. So we spent a good 25 minutes talking about this. So if you want more information on it, you can go dig that podcast out of the archives. So there's a lot of information on there. So my next question to you, Kim, is, so with this next one, why are we adding more to this? What did Congress decide we're missing, or why do we need to do more here?
Yeah, there's a couple of speculative reasons, and I never like to get into politics when you're in the work setting, but it is Congress, so you can't help yourself here.
Right.
But there's a speculation that some of and this is the House of Representatives would be the one putting this forward, and they have actually already put it out there. So it's not like this is all just in the in the vaporware somewhere. This has actually been proposed, but there's speculation that some of them think this is going to help get them basically reelected. That in their district, this is a big issue. The retirement piece of it. The other thing that definitely is on everybody's mind, we just, I don't know if you want to say came out of the pandemic, or we're coming out of the pandemic, or
trying to come out of the pandemic.
Yeah, exactly. We're all fingers crossed, hoping we're getting to the end of it. But we all know 2020 was a tough year, and then even into 2021, again, depending on what business you're in and what part of the country you're in. And so for a lot of, whether it's from a business, an employer standpoint, looking at their employees, or whether it's individual employees, or in this case, it would be participants in a 401k plan, which of course are constituents. Again, you got to remember this is Congress here. A lot of people were really struggling financially. So they were having trouble. How do I pay my bills? How do I pay my rent, or keep my mortgage going? I've got kids home from school, and so now am I juggling my job? And maybe you had people getting furloughed or laid off, or even their employment terminated. I mean, there was all kinds of things going on from an employment standpoint, and so it was difficult for people just to make ends meet. So they were not contributing to the plan. So there's a lot of statistics out there of just almost decimation for people contributing to their 401k plans. And of course, that will cause problems on down the line, because if you're not contributing early on, and we've talked about this in earlier podcasts, you really need to start contributing early and let that be accumulating, over years and years and years. So anytime that accumulation gets interrupted, it causes big problems when you get to the end and you're trying to retire. And the other thing that happened, we know the market was just up, down, and all over the place. So that impacted anybody who's maybe they were continuing on to contribute or maybe not, but they had money in a plan. Those fluctuations, of course, impacted earnings. So I think Congress just kind of looked back and said, we know there's a shortfall anyways. When you look at people getting ready to retire, there aren't defined benefit plans anymore. We all, and again, I don't want to get into the politics of it, but we're unsure about Social Security, don't know what's going to happen there. Probably in the best case scenario, there may still be Social Security, but it'll be at a either much later point in your life or a much smaller amount or both. In either case, you're looking at a whole lot of people retiring in the future with not a lot of money to keep them going post-retirement. And so that's why 401ks were set up in the first place, but this doesn't help fill that short gap if people aren't contributing, their money, isn't earning over their lifetime. Any of that gets interrupted, it causes problems. So that's really why the Secure Act got started, and then this is the Secure Act 2.0 is partly to help with that situation. It's partly just political reasons. I think it's also the folks that sponsored the Secure Act in the beginning, the original one, wanted it to go further. But how the congressional stuff works. It's, you never get everything. So this is, I'm coming back for another bite of the apple kind of thing too, I think is part of the reason.
Yes, that makes sense. Obviously they want to increase the contributions. So we're taking it a little further. So what does the act currently look like, and what are some of the provisions that we need to keep an eye out for?
Yeah, so the tentative name, and again, this has not been passed, so all of this is subject to change. The tentative act is called Securing a Strong Retirement Act of 2020, because it was actually first introduced in October of 2020. And a lot of people thought that this would actually get passed in 2020. There was a big push, and they thought maybe when we get to the end of the year, how the Congress tries to do one last big act and they kind of throw everything in the end or in that last ditch effort. And a lot of times it's a budget act, and then they'll throw a bunch of stuff in. They thought maybe this would get put in there, but it didn't. It did not get finalized or anything. So it's still out there. It's it's still definitely on the radar. Definitely people pushing for it. The people in the know that really look at this and spend a lot of time talking to the congressional folks really feel like 2021 is going to be the year. Now we'll see. We're not quite to the halfway point in 2021. I think a lot's going to have to do with the pandemic, as we mentioned. If we need to. Congress feels like they need to put more money into that, and there's other bills out there, obviously, that the president and some of his staff have been talking about. So it just kind of depends on, can they put this in with something else? Can they? Is there going to be money left for this? And we're going to kind of talk about, why it hasn't passed, and part of it's a money thing too. So let's get to that at the end here. But for right now, let's talk about what are they proposing to be in this, and we're calling it again Secure 2.0. First thing that's been very popular, and you've heard a lot in the news about student loans. So a lot of pressure for those folks who maybe have already graduated college and they're young 20, 30 somethings who have these huge debt out there. And so, here I hit the pandemic, and so now my job maybe is in jeopardy or had reduced hours or whatever. And now I got this big, huge loan out here. How do I get that paid off? And I'm supposed to be saving for retirement. And how in the world am I going to do all of that? So one of the big proposals here is to help with that. So don't know all of the specifics exactly, but what everybody's thinking is that it would allow the participant, or in this case employee, to make their payment to the loan, whatever that would look like in a month or however they pay it off. And then the employer would treat that like a contribution to the 401k, even though it's not. It's obviously a payment going towards the loan. But so let's say you had a $100 payment, and the employer was going to match 50%. They would normally be matching a $50. So $150 would go into the participant's account. In this case, the $100 would go to pay the loan. The $50 the employer would contribute to an account for the participant, and it would help the employee to be saving for retirement while they're still paying down their loan. So very popular provision. There's a lot of support for it, and it's one way to help with the student loan situation without Congress having to fund a bunch of it, because the employer would fund it. So not sure what how employers are going to feel about it, because it's a match, not really a match, and there's implications too for it. So again, not sure exactly where it's going to go, but that's definitely something that we think will probably go. If this act goes, that'll probably go, because it's been very popular. There's also been
just to make sure I'm just make sure I'm clear on it. So basically, if I put money into my paying off my loan, so like you said, I put $100 into paying off my loan, the match goes to my 401k, not to my loan.
Correct.
Okay.
Correct.
Okay.
Mm-hmm. And it would follow whatever the match formula is already existing in the plan.
Okay.
So whatever match you would have gotten had that money going onto your plan, you would get that same match. And all the other rules are the same. I mean, it doesn't change anything with regard to the plan.
Got it.
And it's there is an IRS ruling around allowing people to do this already in plans. It's not really kind of authoritative guidance. Someone submitted a situation and the IRS allowed that to go ahead. So they're saying we can't say this is okay for everybody, but you can already see the push for employers going down this path. So
Makes
we
sense.
definitely think this will be probably included if the act actually ever does pass. Second thing is that all new plans would have to be auto enrollment plans. This is a little bit different because we've had auto enrollment before, but it's never been required. So this would actually require the auto enrollment. It would start at 3%. It would go up to 10%, but would allow for employees to opt out, which of course is always true with the auto enrollment. And it would allow plans that are already in place that don't have auto enrollment. You would not have to implement it. So if you're already there, you can leave it the way it is. But if you set up a new plan, you have to do the auto enrollment.
So for newer businesses or businesses that right now might be thinking, oh, it might be time to get a 401k plan. If this passes, you will be required to do auto enrollment going forward.
Right,
Okay.
right. And the Secure Act has some credits that you can get back for setting up plans with auto enrollment. So it's kind of a,
Forcing the credits.
incenting you all the way around to do it that way. This would increase also the required minimum distribution age up to 75. It was 70 and a half with provisions. Other provisions that went to 72, and then we had with some of the COVID things that happened, the CARES Act, it was kind of waiving RMDs for a while, and so now this would raise it up to 75. There's a lot of different opinions on this one. You kind of got there's mixed things going on. You've got folks living longer, so we don't really want you to use up your retirement savings, and then you got another 10, 15 years of life, and how are you going to fund that? People are living longer and living healthier longer, so they might want to spread that money out because they really could use it to do fun things and things that they saved up for all their life. So there's kind of that school of thought. There's also the school of thought that from a tax standpoint, the IRS doesn't like this because it's delaying. The whole point of the required minimum distribution is, you probably put that money in your 401k pre-tax, so no tax was ever paid on it. The IRS is fine with that, but once you hit retirement, they want you to start paying some tax on that money. So the longer you leave it, that's another problem with this act, is that it's not a good impact on the overall, trying to balance the budget thing. So that's kind of a controversial piece, but There's mixed feelings. It also would increase the catch-up contribution limit as employees reach the retirement age. So again, recognize the fact we had COVID. For those people that are getting really close to retirement and they're trying to get as much money in their plan as they can, and I had a setback last year potentially because maybe my hours got cut or I lost my job, or so it's once you hit the age 60. Going forward, the limit will go up currently from 6,500 to 10,000. So it gives you a little bit more room that you can contribute a little bit more. I don't think there's much controversy on that one. Big thing here, this is the big one, I think, for people. And we just mentioned this, the part-time folks, 500 hours in each of the 3 years. Potentially this would change it to 2. So if, depending on when this would get issued, when things would become effective, potentially in next year, by the end of next year, it would be the next year. So we would be 2023, the beginning of 2023, potentially, you could have to start letting all these part-time people in, and you would have had to track their hours. And I think people are looking at 3 years. I got plenty of time, but this could really force your hand and make you, have to be doing it really quickly. And if you figure we may not know if this passes till the end of the year, you've already blown a year of time that should have been tracking, and now you've only got a year to get this all set up. So that's really why I wanted to bring this up. If we know the Secure Act, that's the initial one, Secure Act 1.0, is in effect. It's definitely happening. The 3-year thing is happening. They're not going to change that. Right. This would just make it worse because it would make you have to do it sooner. So my recommendation is get on it, start tracking now, because it's not going to get better. It potentially could only get
and
worse.
Anytime you have to implement a process like that, there's always going to be bumps along the way. So you want to make sure you get those bumps ironed out. And again, like you said, if they move it up to 2 years, then you're going to have to figure that out. And if it's the 3 years, you want to get those bumps ironed out right away. So I think it's right. Great advice. And I think, like you said, if it's the one thing people catch from this podcast, it's probably the thing, is to make sure you're tracking those hours.
Yeah. And it's, your business. If you're pretty stable employment, maybe this isn't that big of a deal for you. You don't have that many part-time people, but there's a lot of business. We have a lot of clients that have seasonal employees. They have a lot of in and outs, hires and terms, and a lot of part-time people. So kind of depends on your business, whether that's a big deal or not. The other things they're not big deal. There's this disclosure change. It'll make it a little bit easier for administration. I think everybody's would like that. It expands some of the involuntary correction programs that the IRS has, which are helpful. And we've talked about on other podcasts some of those correction programs. So I'm not going to go in a lot of detail here. We don't know exactly what it would look like, but that would be a good thing. I don't think anybody would be arguing those. And it allows for plans to be amended by the end of, I've got 2020 on here. I'm not sure that's right, but it would change when the plan amendments have to be done, because all of these acts that we've been talking about, the CARES Act, the Secure Act, et cetera, require you to amend your plan, but most of these allow you to do it later. So they're giving you a little bit of time. You can implement now and officially amend your plan a little later. So it gives you a little bit more time for that. So you're all saying, why do I care about this? Is it going to pass or not? Best guess, current thinking, is that it is expected to pass during 2021. Not sure exactly when, but that is the insiders that are talking to Congress. It's a big deal for them. I think they've got, those elections that happen on the congressional cycle, I believe, is next year. So I think they want to get this in and be able to tout, look what I did for you. So most bets are that it's going to probably pass during 2021, and the current expectation is that it would become effective 1/1/2022. So that's not that far away, really.
Yeah, that's right around the corner.
Yeah, when we start talking about this could have a big impact on your administration. Now, why isn't it already there? Why, if everybody's so big on it, why is it not already passed? What happens when you puts forward a bill like this, it has an impact on the budget. So what happens is it has to go to what's called the Congressional Budget Office, and they have to do a process, and I forget the name of that, but they have to go through and kind of like score it and say, based on whatever the provisions are that they're given, so whatever that looks like, we estimate the hit to the bottom line for the country is an up of so much, or it's going to cost us, a negative of so much. And of course, there's probably back and forth and everything else. They expect this will be a hit to the bottom line. So it's going to cost taxpayers money. And I mentioned like the increasing the RMD age is a hit because that would be money coming into the Treasury that they could use now, which of course you're delaying it potentially almost 5 years. So that would be a hit over those 5 years. And we're already a hit to the Treasury because of the pandemic and people not having income tax payments because they lost their job or, whatever the pandemic did to their salary. So there's a lot of question about, it's a great idea, everybody loves it, but how are we going to pay for it? And that's the unknown at this point. And the research I did shows it's still with this group, this budget office. So they've got to come back with the number. And then once they do that, then it's up to Congress to say, okay, so now here's what we're proposing. And that would change potentially what goes in the law. So they may say, we love everything, we clearly can't afford it, so we'll slap out that RMD piece. And then that would make the number come down to an acceptable level. That would be an example of something they could do. So that's where it's set. So if they can get that over that hurdle, that, like I said, this is already out there. It's not like they got to draft it up. It's already there. They would just have to finalize it and then put it forward for a vote. So probably pretty close.
I think that's so like you said, it's next year, beginning of next year would be a big turnaround. So I think the biggest thing is to kind of keep your ears to the street, and we'll keep, as we do this podcast, if we hear that it passes, we'll obviously do an update along the way. But I think a lot of big changes there. I know the couple of things you went to, there was a couple that jumped out to me, obviously, that we'll have to keep an eye on, and would definitely change the way you're administrating a plan, especially the kind of the big two you talked about there. So I think that's great information. I want to throw our email address out there. So we're always looking for new topics. Haven't had many guests on this show. So if anybody wants to be a guest, we'd love to have them jump onto this podcast. But, the email address is audit@summitcpa.net. Again, audit, AUDIT, at SUMMITCPA.net. So we'd love to have you on the show. Or again, we're always looking for new topics. I know this was a big one. I'm sure a lot of people will listen to this one because it's something that's out there. And anytime things that are unknown, the more information you can get about them really helps. So Kim, definitely appreciate all the information you provide. Any kind of final thoughts for our listeners?
No, I don't think so. As you mentioned, we'll kind of keep watching. And if we hear anything, we'll let you know. I also do a blog weekly, so we'll put it out there in the blog as well. So kind of take a look at that and be watching, and that's probably where we'll put it first if we hear anything, or any updates. If I'm hearing, it's going through the process and there's these changes, we'll be putting that out in the blog. So check that as well, and but we'll keep you posted.
Great. Well, as always, I appreciate all your information, and I'm sure our listeners do as well.
Thanks, Jamie. Thanks everybody for listening.
Enjoyed this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving 401k audit success. We're here to be a resource with ever-changing rules and regulations.